continue. So now we'll cap it off by looking at treasury strategies and performance optimization strategies that a treasury department can look at. You remember how we said one of uh, the functions, the critical functions of any treasury department is also capital optimization, right?
Yes.
At the same time, they need to do capital adequacy and management to comply with the Basel III requirements of the Central or Reserve Bank. They also at the same time to ensure that they optimize their investments and also capital to minimize the risk and also to increase their profitability to be able to handle or absorb any losses that the banks may incur or to handle any surge in withdrawals and other market downtimes. Okay. So, treasury management encompasses such several functions, for example, from liquidity management to risk management, and also capital management, which is basically profit optimization and capital optimization in that regard. So we find that when these functions are aligned, then the organization can basically see that their ALM strategy, their overall treasury management is effective. And because it's basically to achieve, for example, liquidity, profitability, their risk resilience, and at the same time, capital and cost optimization, they need to they need to really put in place the different strategies and frameworks that we've been discussing. Okay, so we are about to see how these objectives now, the objectives that we just discussed, align with, for example, a reserve banks or a central bank or a commercial banks, their strategy, their overall strategy, and their, for example, liquidity management, profit strategy, funding strategy, cost strategy, things like that, and even their risk frameworks. We also try to look at maybe a case study to see how a particular bank's profit strategy, cost strategies, and other treasury management strategies aligned with their overall corporate strategy. So, as we said, let's start on the first function of any treasury department. That's the most critical. Which, according to you, do you think is the most critical function of the three?
Of the three.
Yeah.
Okay. I could say they are intertwined, okay?
Yeah,
But
it
let's
depends with
say,
also the size of bank, right?
yeah, but
Because you find in Taiwan banks, liquidity optimization is also very, very key.
yeah,
Because
so
before you can even think of, you must have the liquidity to comply, to even be allowed to operate, to do your capital management, to optimize costs. I
yes,
think so. Yeah, I think so too. Yeah. So we said it's the most critical aspect of any treasury function because it ensures that the bank has the necessary funding and enough capital buffers to effectively not only absorb any losses but also handle any short-term obligations and also surge in withdrawals, especially during market downtimes and economic distress. That's what we saw even during stress testing. So,
yeah,
therefore, treasury managers must ensure that their liquidity levels and liquidity ratios, as required by the central bank or reserve bank, are adequate as recommended. For example, by monitoring their cash flows, by monitoring their and also even reporting on their ratios and their risk resilience, basically their liquidity levels in terms of the liquidity ratios. For example, the LCR, liquidity coverage ratio, and the net stable funding ratio (NSFR), and also the size of their HQLA, high quality liquid assets. They must make sure that they have enough capital buffers. Okay, so for example, let's look at let's say a KCB bank or National Bank of Malawi is planning to, for example, to expand to National Bank of Malawi is planning to, let's say, create a branch in Kenya. So what will be the role of Treasury Department of National Bank of Malawi? They one will look at how to now fund the expansion. For example, are they going to issue new debt? So that will also impact on their ALM strategy and overall liquidity. Are they going, for example, to use retained earnings, or are they going to even take a new foreign-backed security. Okay.
Yeah.
Yeah. And then, so they also must analyze the risks involving in such expansion. That's a cross-border expansion. Forex risk will arise. Interest rates risks will arise. Default risk, all the other types of risk. What are the appropriate, for example, risk mitigation and hedging strategies that they will use in order to hedge their bank or their treasury department against such risk? They could use, as we saw, currency swaps in this case between the Malawian kwacha and the Kenya shillings, or forward contracts, so that they protect the bank from, for example, any unfavorable movements or fluctuations in the rate of the Kenya shillings against the Malawian kwacha. They must also now ensure that what they are trying to achieve, their overall, for example, liquidity and funding strategy, for example, align with the overall, for example, cost management, and risk optimization, the overall corporate strategy, I would say. Okay.
Yes.
For example, if they are planning to have, for example, a 45% market share, that means that they must retain earnings of what levels? They must have cash and cash equivalents of what levels? Their assets holding. Okay. So they must ensure that all those liquidity management indicators all align to the overall corporate strategy that they are trying to do. Okay. Then the next one is risk management. Okay. While they are now, for example, expanding, then they, as we said, they will risk, they will face some risk, for example, forex risk and also currency risk. So the Treasury Department at such National Bank of Malawi will be tasked with managing the various risks that they will face. For example, it will need to look at the monitor, for example, first monitor, identify and then monitor, and then be able to put in place the various risk mitigation measures. But they must also be able to even calculate how much it will impact, for example, the NIM, the NII to the net interest income. Okay. By looking, for example, at the gaps in interest rates and also forex. Okay. So one, they need their strategies, or their role in this case will now to be to implement, for example, the different hedging strategies. As we saw, for example, they could do a currency swap, or a future option, or a future contract rather. Okay. And then they need also to monitor these risks and also report them. As we saw, also the Central Bank of Kenya, or in this case the Reserve Bank RBM, Reserve Bank of Malawi, will also be imposing some risk resilience and reporting standards. Okay, in compliance with the RBM's, the Reserve Bank of Malawi's requirements, but also even in the international financial reporting standard IFRS.
Yeah.
And similarly, just like liquidity management, they must ensure that such risk management strategies also align with their overall risk goals and corporate goals and strategy, basically. So the strategic role of treasury, it can even include even it does not stop there. It does not stop in liquidity management, in risk management, and capital management, but it can even go further, as to, let's say, in this case, the bank may consider, when it wants to, it is strategizing to expand into, for example, a foreign market. It may even, what it may consider the different acquisition strategies. They could enter into an M&A, merger and acquisition.
Yeah.
For example, when they wanted to enter into Tanzania, they acquired Akiba Commercial Bank, ACB.
Yeah.
Okay. So now in this case, what was let's say that as an actual case study example, what was the actual role of Treasury Department of the National Bank of Malawi in the acquisition? Was it a merger or acquisition? Acquisition, right? They took a majority share. I read that
Yes.
around 51%, and there was even plans for them to buy more shares in it.
Yeah.
Okay. So what role, as per the Treasury? in line with the treasury roles that we looked, what was the role in such a case study. Yeah. So now try to bring the point home a little bit clearer. So, for example, let's start by looking at each kind of role. Liquidity management. So you find that they were able to manage the liquidity of now Akiba Commercial Bank. Okay, because at this time they were acquiring Akiba Commercial Bank, it must have been because the liquidity levels of Akiba Commercial Bank were very low and were not compliant and were not enough. There were not enough capital buffers for it to even be able to, as you even see that we even looked at the actual reason that it collapsed. It had to do with capital ALM basically. Okay, so for example, they secured additional funding. Okay, they issued new shares or retained earnings, or maybe they skipped on paying dividends to Akiba Commercial Bank's dividend holders or shareholders to be able to secure additional funding and ensure there is enough cash flow to get Akiba Commercial Bank up and running. Okay, and basically complete the acquisition and entry into Tanzania. So if National Bank of Malawi is trying to acquire ACB and enter into Tanzania, then the Treasury Department at NBM, the National Bank of Malawi, will need to coordinate financing, whether it's through the various funding sources, for example, issuing new debt or even using from their own reserves. Even if sometimes it might even be possible to access some of them emergency credit line that the Central Bank of Malawi may extend to them. In this case, Central Bank of Tanzania, right?
Oh yeah, but
Exactly.
yeah, I don't know what really went into the negotiations.
But I
Yeah,
don't think, since the ACB was not compliant in the way to begin with, I think it would be very hard to access some of these emergency credit line that the central bank may offer them, right? Yeah, but there always are other options that they may have used. Okay. Also, as part of the merging and acquisition, uh, as part of the merger and acquisition of ACB by NBM, uh, the Treasury Department of the NBM must ensure that there is enough capital to not only complete that acquisition but also even to run it, to get it up to profit making levels again, at a point where they also are compliant with the CBK and the RBM requirements, and also they are able to meet their short-term obligations, such as withdrawals, and also if they have any, for example, interbank borrowing debt that they had.
it's an interesting case.
Mm. It is.
Look at its financial statements
Mm.
for